Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The neckline extension to the February to April reverse head and shoulders pattern, currently at 567, my apologies, slowed down and eventually halted the decline from May, and during July and August halted a resurgence higher. Additionally, the congestion we saw previously from mid-February to late April impacted on the market's decline, and we formed a small bear channel since late June to the end of August. This bear channel was part of the V-top formed in May, in essence a V-top with an extension. Pressure in such a pattern tends to be for lower prices, but 5 weeks ago the market struck down to the important 38.2% absolute Fibonacci line of 521, which ignited the next phase, the very recent bullish incentive, enough to push up and out of the bear channel, as well as over the short medium moving average, currently at 572, the December 2020 low at 566, the neckline extension, and up through the previously mentioned mid-February to late April congestion, as well as the newer July to August based congestion that stretched up to the March 2021 low at 592. And then late 3 weeks ago, prices pushed up over the July 2021 low at 609. However, this move up was not sustained, as up there we also had the combination of flatlining long moving average currently at 594 and the slowly dipping medium moving average currently 596. These two, plus the surprising resistance of the July 2021 high at the time at 609, which to be honest I previously hadn't rated very highly, had sort of capped the rise, or at least made the market think twice about the rise over September. All this was interesting, as beyond these we have open air until the base of that old small descending triangle back in June in the 629 area, and also at the 50% Fibonacci line of the late May to late August move at 630. And move up we did this week, up into the body of that old small descending triangle before peaking in the middle of this week. 4 weeks ago I said, and I quote, "We need to at least be seeing consecutive closes over the 50% Fibonacci line of the May to August move at 630 to consider such a situation as a long-term possibility." All that being said, enough has happened for me to place a target X at 604 as a potential target for this move up and out of the bear channel. End of quote. These words still stood, and target X at 604 was achieved during September and now exceeded in October. So what has the market created in September? Well, it looks very much like a dark blue highlighted bull channel, currently 605 to 645. It is not a great looking example of a bull channel, but it does still exist. The key to sustain this bull channel will not just be staying above the lower bull channel line, but staying above the July 2021 low at 609 and trying up beyond the 50% Fibonacci line at 630 once again, and finally trying up towards the interesting 50% Fibonacci line of the March 24 to August 24 move at 658. All in all, a tall order with many things that could go not wrong, but awkward. Chicago corn. From the small double top pattern in May, prices headed lower, below all the moving averages in mid-June, accelerating the fall once past the hurdle of the November 2020 highs at 439. Prices finally halted in July between the November 2020 low at 403 and the October 2020 low at 387, creating a teeny triple bottom and recovering 8 weeks ago up to the 50% absolute Fibonacci line at 425. Now remember that 425 level, it will become important in the future. Anyway, in the process of pulling back up, the market made a possible ropey double bottom and a small July-based descending wedge pattern. Late 10 weeks ago, prices penetrated the lower trend line and exited the pattern of the ascending wedge pattern. The market easily reached the primary target, but it took until mid-August to drop down and reach the secondary hard to reach target. 7 weeks ago, I added a thought, and that was to look at the mid-June to late August action as also a possible descending triangle. There were arguments against this idea, but I did find it elegant at the time. 6 weeks ago, prices exited out of the upper trend line of this descending triangle idea, but instead of heading higher, they headed lower, down towards a flat lower trend line. This looked like a false break higher, but instead the market also created another pattern, a late July to late August shallower and smaller descending triangle. This triangle, like the former one, had false breaks lower, and it was finally 5 weeks ago that we saw its true direction upwards. Prices punched through and for a while ran along the top of the late May to mid-September downtrend and its then accompanying partner, short-medium moving average, currently at 412. This break higher reached the primary target for the descending triangle and 2 weeks ago gapped up over the secondary harder to reach target at 418. We saw prices even higher, including changeover. The move up has pushed through the February low at 409, the December 2020 low at 414, the significant, important and previously mentioned 50% absolute Fibonacci line at 425, as well as the declining medium moving average currently at 424. Last week prices came up against the next series of overhead resistances. The November 2020 high at 439, which supported the market back in late March and April, as well as the declining gold highlighted long moving average, currently at 438. The market finished last week by forming a weekly key reversal up, and this week we've punched through these resistances into another congestion area. You see, we have congestion between 440 to 450 dating from late March to late April, plus further congestion around 455 dating from June, and finally the lower trendline extension to the July 23 to January 2024 descending triangle, currently at 465. To cope with these, prices have started to form a possible ascending wedge pattern since mid-September, and that's currently 440 to 456. I've not highlighted this pattern, not yet, unlike others elsewhere, as it's still pretty nascent, steep and narrow, and I'm not sure of its sustainability. However, it is there, and for now I'd watch it to give an idea of the bullish angle of attack of this market. Kansas City wheat. During February through to April, we saw the development of a rectangle pattern based around the 551 to 590 area. Now, please remember this area as it becomes relevant to more recent action. Anyway, over the creation of the V-top in late May, prices rapidly descended down to the extension to the lower trend line, currently at 579, of the late November 23 to end of March 2024 descending triangle, along the important July 2021 low at 578, and the March 2021 low at 559, back into that previously mentioned rectangle pattern area between 551 to 590. Prices subsequently moved sideways to lower, making a shallow bear channel. Altogether, this pattern construction is the familiar V-top with an extension, as we have seen in other grain markets. Hence, I have said here for weeks now to look for the bear channel to show immediate support and resistance levels, and it did so more or less until 4 weeks ago. I'd also said for many weeks that the pressure in any such pattern would be for lower prices, but the move lower 6 weeks ago was not sustained, and the market reverted back up, moving higher from the significant support of the important 38.2% absolute Fibonacci line at 553. The move up went through the March 2021 low at 559, the short medium moving average currently at 577, and punched up and closed over the combination of the July 2021 low at 578, the old lower trend line of the descending triangle, and of course the upper bear channel line. 4 weeks ago I said, and I quote, "This move higher is having trouble in sustaining the move higher, running into the highs of early and mid-July and mid-August, as well as the top of that old rectangle congestion area between 551 to 590. Beyond these resistances, we have a fairly free area until the flatlining pair of the gold long moving average, currently 605, and the mauve medium moving average, currently also 605. And the interesting 38.2% Fibonacci line, the big old 2011-2018 move at 618. Beyond that, we have a small free area until the recent 50% Fibonacci line at 643 and the January 2015 high at 646. All this is leading me to think that this very recent move higher may not have the legs to get up through all these. To show you how I feel about it right now, this is despite the weekly key reversal up last week. So that is now 4 weeks ago, the weekly key reversal up. And even to target X at 627. This is the topside target I felt obliged in putting after the break up and out of the bear channel, even if I don't have that much confidence in it being achieved soon. End of quote. Well, the action since then, and I quote from 3 weeks ago, specifically on the bright green short medium moving average, well, it may have gathered enough ammunition to tackle these overhead resistances, specifically the gold long moving average and the mauve medium moving average, and may just reach target X and even exceed it, because beyond target X there is only the January 2015 high at 646, which doesn't look that strong. That is only in the way to possibly reach the 50% Fibonacci line, the big 2011-2019 move at 691, end of quote. Well, this week prices punched up through the long and medium moving averages, the 38.2% Fibonacci line at 618, and peaked out just under the January high at 646, whilst also fulfilling target X at 627. In doing so, the market has created a pattern to try and take on these overhead resistances and congestions. A dark blue, late August to date bull channel that is veering towards being an ascending wedge pattern, and it's currently 596 to 641. For the moment, I would suggest following this bull channel to show the bullish angle of attack of this market. Please bear in mind that it's still a relatively early pattern. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.